If your lender tells you that you've hit a limit to the number of properties you can buy, or maybe they say you don't make enough money, or worse, they just flat out deny your investment loan, you probably aren't using a DSCR loan. I'm Greg, and I'm a real estate agent and investor with 25 doors here in College Station, Texas, home of Texas A&M. And this is the exact loan product my experienced clients are using that your local bank has probably never heard of. In this video, I'm going to show you exactly how DSCR loans work and the one mistake that can kill a deal. By the end of the video, you'll know exactly how to fund your next property, even if the bank already told you no. All right, let's talk lending. Traditionally, you had two options to finance a rental property. Option one is the conventional investment loan. These are great until they're not. The bank looks at your personal debt to income ratio, also called DTI. If you've got lots of debt, for example, student loans, a car payment, or you don't show a lot of income because maybe you're self-employed with a lot of write-offs like this guy, well, then the bank looks at your tax returns and denies you based on DTI. These loans also often have a limit, usually 10 properties. So what do you do when you hit that limit or that DTI? Well, your second option historically has been commercial loans. This is the side of the bank that also lends to businesses. Unfortunately, if you're buying a single family house near Texas A&M, commercial loans are usually cash flow killers. You see, these come with higher interest rates, hefty fees, adjustable rate mortgages, and shorter amortization. Think 20 years instead of 30. Your monthly payments are going to spike, and that great property is suddenly losing money every single month. So what do experienced investors do when they max out on conventional and commercial loans are killing their numbers? That's exactly what we're going to cover next. But real quick, if you're running into roadblocks right now trying to get your first or next investment property off the ground, go ahead and shoot me an email. Send me the word START to info@schwartzrealtygroup.com, and I'll reach out to you personally. We'll figure out your next move together. So enter the DSCR loan. This stands for Debt Service Coverage Ratio. And 5 years ago, nobody was talking about these because they didn't really even exist. But today, this is the fan favorite. Here's the core idea. A DSCR loan does not care about your W-2 income. It doesn't care about your debt to income ratio. It doesn't care about how many mortgages you have. The lender asks one simple question. Does the rent coming in cover the mortgage payment going out? And that's it. The formula is actually pretty simple. You take the monthly rent and you divide it by the total monthly mortgage payment. Of course, that includes your principal, your interest, your taxes, property taxes, insurance, and an HOA fee if there is one. That's your DSCR. That's the ratio. And if that number is 1.0 or above, meaning the rent covers the payment, well then you likely have a loan product that you qualify for. Your personal income, it's completely irrelevant. And when you hear that again, you could quit your W-2 job tomorrow and still get approved for this loan. Let me show you exactly how the math pencils out and how these play out in real life. So let's say we find a 4-bedroom house in Southwood Valley. It rents for $2,200 a month. Your total mortgage payment, PITI, comes out to $2,000 a month. Back of the napkin math, $2,200 of income divided by $2,000 worth of mortgage payment equals 1.1. We're above the 1.0 threshold. The loan gets approved. You get a new rental. But now let's look at another scenario. The same house, but this time a weaker rental neighborhood. So now rental comps come in at $1,800 a month. The mortgage is still $2,000. $1,800 divided by $2,000 equals 0.9. Well, that's less than 1.0, and a lot of investors, they'll stop right there. They'll walk away. They'll say, hey, this isn't the right deal. But here's the thing. A deal that doesn't pencil out, it's not dead. It's just an opportunity to negotiate. And here's exactly where a great investor agent will earn their commission. You see, we might need to go back to the seller and negotiate the price down until the math clears that 1.0 ratio. Or, hey, we might ask for a seller credit towards a rate buy down. Lower the interest rate, lowers your PITI, and suddenly your DSCR is back above 1.0. Or we provide rental comps to the bank to support a higher appraised rent. These appraisals often catch newer investors off guard, and working with the wrong professional could mean that the deal blows up at the last minute, but more on that here in a little bit. First, I want to talk about the downside to these loans, because this is the part that almost nobody mentions. DSCR loans used to carry higher interest rates, usually about 0.5% to a full percent more than conventional. And honestly, that scared off a lot of investors. But here's the good part. That's behind us. Actually, that's no longer a factor. The rates are actually pretty competitive. But in a lot of cases, there's an upfront origination cost that can be as much as 1% higher than a conventional investment loan. So on a $250,000 property in BCS, that's an extra $2,500 out of your pocket. Not the end of the world, but you need to know this up front. And the other one, well, that's a prepayment penalty. A lot of the DSCR loans will hit you with a fee if you sell or refinance in the first 3 to 5 years. But the good thing is we are buy and hold investors. So if you're a flipper, this isn't a loan for you, but if you're buying a rental property to hold on to for a decade, well, that prepayment is basically irrelevant. So let me show you where the real risk is with these loans. And the good news is it's not in the math. The mistake is overconfidence. This could be a new investor or maybe an inexperienced real estate agent. And here's exactly how that deal falls apart. See, the lender is going to order an appraisal, and that's very common, but this is not just your value appraisal that matters. It's also the appraised rent rate that matters, maybe even more so. See, the appraiser is going to determine market rents. And if you overestimated the rent rates, or your overeager agent told you that the house would rent out for $2,500, you might be caught off guard when the appraiser tells you that the rental comps show $2,000 a month. Well, if your mortgage payment's $2,200, your DSCR just dropped below 1.0. You lose your inspection money. You lose the appraisal fee. The house, it's gone. And that's not a hypothetical. I've seen this happen, guys. So if you're using this product in Bryan and College Station, you want an agent who really knows what the rental comps are, specific to the actual street, the type of house that you're looking to buy. You want to run the DSCR math up front with accurate rates before you ever make the offer, not after, and definitely not at the time of the appraisal when you find out the deal's going to fall apart. You want to do all this beforehand. And of course, we want to use lenders who close these loans in their sleep, because that just increases the chance that they'll be able to catch any other gotchas along the way. So here's your 3-step action plan. First, step 1, run the DSCR math on your target property before anything else. Take the projected rent, divide that by your estimated PITI, and make sure that number's above 1.0. If it is, keep going. If it's under 1, well, it's time to negotiate, or maybe you just have to walk away if it's that bad. Step 2, find a lender who specializes in DSCR loans. Not your local bank, and probably not a big national lender. You want someone who specializes in investment property loans. Step 3, get pre-qualified based on the property, not your tax returns. Bring the address, the rent comp data, and let the asset do all the talking. If you want help running the numbers on a DSCR loan, or you want to connect with the lenders that I work with on a regular basis, hit me up. Again, just shoot me that email to info@schwartzrealtygroup.com, and I will personally respond to you. And if you're not ready to make that leap quite yet, and you want to learn more about the local Bryan and College Station market, I recommend you check out this video right here.